But here's my analysis on something that could potentially be true as someone who is invested in NIO and follows NIO closely. NIO could be spreading themselves a little too thin. Many startups focus on doing one thing extremely well, but NIO's fighting a lot of battles simultaneously, trying to sell premium EVs under the NIO brand while launching two sub-brands and really rolling out two sub-brands this year. I know that the Envo came out in the tail end of last year, just one model, the L60, and never really reached scale just yet, but essentially they're rolling out Envo and Firefly this year at the same time. They're also building a battery swap ecosystem, developing their own chip for autonomous and intelligent driving, and they've even ventured into smartphones. What's going on, everyone? My name's Obi and welcome back to the Courtside Financial Podcast. Today we've got a pretty interesting update on the tariffs following the news that we spoke about last week. And remember when I said that there are really no winners when it comes to trade wars? Well, we've got some bombshell data that's coming out to support all of this, or that statement I should say, in a pretty dramatic way. We're seeing a massive supply shock hitting the US automotive market that nobody anticipated. Plus we've got some major leadership shakeups that we're seeing at NIO, which are underscoring their urgency to obtain some profitability this year. But before we dive in, huge thanks to everyone who engaged with Thursday's episode on the tariffs. Your engagement goes a long way. It also is good to have discourse with you guys and not just to be talking out into the universe. Your interaction actually shaped some of the things or shaped how I'm covering this story today. So let's start with the bombshell data that dropped last week. Remember those 25% tariffs that the Trump administration imposed on all cars not made in the US? Well, just over a week since that announcement, we're witnessing some reaction that nobody over in Washington seemed to anticipate. According to data obtained from an analytics firm, Vision, total container orders to the US seemed to have dropped last week. They dropped from 516,000 to 169,000. That marks a 67% drop in just a week. This isn't just cars, this is across the board, but automotive imports seem to be leading in the decline. What's particularly shocking is how quickly automotive manufacturers have responded. Rather than simply absorbing the cost or slightly raising prices, we're seeing that automotive manufacturers are actually cutting off the supply of vehicles to the American market. And I mean this in the most literal way. Let's break down who's doing what, because this is unprecedented. Land Rover Jaguar was the first to make a move. They announced that they're suspending exports of the UK-made models to the United States for at least a month while they figure out how to handle these increased costs. Now, just to put this into perspective, Jaguar Land Rover's US market generated 6.5 billion in revenue last year with 82,000 vehicles sold. That's more than they make in their home market, and even more than in China. So clearly this isn't a small player taking a break. This is a major luxury automaker essentially saying, we can't make the numbers work right now. But the real shocker came when Audi dropped a bombshell on their US dealers. In an internal letter sent on April 7th, Audi announced that they're completely stopping deliveries of new cars to US dealers. Any vehicles that arrived after April 2nd are being held at ports. They've told dealers to focus on inventory liquidation, which is corporate speak for sell everything you got because there's nothing else coming. Now, Audi only has 37,000 vehicles in US territory that aren't affected by the new tariffs. With monthly sales of around 20,000 vehicles, they're gonna burn through that inventory pretty quickly. After that, guess what happens? If things continue the way they're going, Americans that want a new Audi will just be out of luck. And it's not even just Audi. Their parent company, Volkswagen, has suspended the entry of vehicles from Mexico into the United States by railroad, and they're holding shipments on European parts. Mercedes-Benz, they're also considering removing their entry-level models like the GLA and the CLA from the US market entirely because tariffs can make selling these lower margin vehicles completely unaffordable. Now, Stellantis, a lot of you in the US may not know about them, but they're the world's fourth largest automaker. They responded by laying off 900 employees at 5 US factories and suspending operations at assembly plants in Canada and Mexico. Nissan, they stopped accepting new US orders for the Infiniti QX50 and the QX55 SUV. Mitsubishi has halted all vehicle shipments to US ports. This isn't just a minor adjustment, these tariffs. This is a entire wholesale supply shock that's hitting the US like a wrecking ball. Now, some might say, well, won't American car companies just fill the gap? The reality of that question is, or the answer to that question is that it's far more complicated. Half of all new cars sold in the US are imported. Even the domestic manufacturers, they're depending heavily on global supply chain. They've got 30 to 50% of their vehicle parts and their costs coming from Mexico, China, Canada, Japan, South Korea, and elsewhere. According to Cox Automotive, these costs will add $3,000 to $6,000 in increased costs for vehicles manufactured in Canada or Mexico. By April, literally any day now, they're predicting that U.S. vehicle daily production could drop to 20,000 vehicles. That's 30% of total vehicle production. These prices are even already hitting consumers. Ferrari was the first out of the gate with price hikes of up to 10% across their lineup, except for a few models, and that increases to between $25,000 to $350,000 depending on the model. Porsche, they've already signaled that they're following suit. Here's the real kicker that nobody's talking about. The hardest hit segment of the market is likely to be economy cars, the vehicles that working class Americans can actually afford. Reuters found only 16 car models in the US with a price tag below $30K. Care to guess how many of those are actually made in America? Just one. Toyota Corolla. All the others are coming from Mexico, South Korea, Japan. So while policy was intended to protect American jobs and boost domestic manufacturing, the immediate effect is that Americans will soon have less options to choose from when it comes to vehicles, and those that remain will cost substantially more. This is exactly what I meant in the last episode when I said that there's no winners when the tariff gun goes off. If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. Now let's pivot to NIO, a company that you guys know I follow closely. I'm still invested in, and if anybody had any doubt, I'm a bull long term, and I'm optimistic, but NIO's had some leadership shakeups again. On April 10th, NIO's announced major personnel shakeups through an internal email. This follows the April 2nd resignation of Ai Cheng, who's the president of Anvo. Several other executives are leaving and or changing their role. The user relationships department is getting some new leadership, with Soon Ming taking over after Shen Hong's departure. The Shanghai regional company is getting a new general manager, Xiao Qinghua, and perhaps most importantly, NIO is consolidating several departments: brand and communication, vehicle and technology communication, market coordination, and market planning. They're consolidating all of this into a single department, which is marketing and event planning, which is going to be led by Ma Lin. These organizational changes might seem like insider baseball, but they signal something much deeper: William Li's growing urgency to hit that profitability target by Q4 this year. Let's be honest about why these changes are happening. Sales performance. In the first 3 months of 2025, Anvo delivered 5,912 vehicles, 4,049 vehicles, and 4,820 new cars, respectively. That's nowhere near the targets that the president, who's recently resigned, set last December when he projected that Anvo L60 deliveries would hit 10,000 in December and climb to 15,000 in February and reach 20,000 in March. The main NIO brand isn't even faring much better. They delivered 27,313 vehicles in Q1, which sounds decent until you compare it to Xpeng, who delivered 94,408, and Li Auto's 92,864 during the same time period. NIO's getting outpaced by its direct competitors by more than a 3-to-1 margin. This underwhelming performance explains why NIO is having all of these incentives and price promotions in early April. Remember when William Li insisted that NIO will not cut its prices? Well, they're not calling them price cuts exactly, but the discounts are substantial. All this is aimed at achieving NIO's ambitious sales target for this year, 440,000 vehicles. That's double what they did in 2024. And to do it, they're banking on 9 new products across all of their brands. But here's my analysis on something that could potentially be true as someone who is invested in NIO and follows NIO closely. NIO could be spreading themselves a little too thin. Many startups focus on doing one thing extremely well, but NIO's fighting a lot of battles simultaneously, trying to sell premium EVs under the NIO brand while launching two sub-brands and really rolling out 2 sub-brands this year. I know that the Envo came out in the tail end of last year, just one model, the L60. It never really reached scale just yet, but essentially they're rolling out Envo and Firefly this year at the same time. They're also building a battery swap ecosystem, developing their own chip for autonomous and intelligent driving, and they've even ventured into smartphones. William Li has claimed that these sub-brands weren't a desperate move, but rather a natural move or a natural evolution of their technology platform. However, the Envo L60's lackluster sales tell a different story. After initial enthusiasm, their sales dropped from 10,000 to 5,000 vehicles per month and under 5,000 vehicles per month in the first months of 2025. Meanwhile, NIO's ambitious European expansion has limited some pretty underwhelming results, and the executives at the company have said this as well. It's documented. But the facts are, despite building nearly 100 NIO centers, spaces, and service centers in Europe, along with battery swapping stations, they sold just under 1,600 vehicles there last year. That's less than 1% of their total. In January and February of this year, European vehicle sales were 31 and 73 respectively. I believe that we're seeing a good fundamental shift in William Li's approach. He's long had a reputation of the good guy of the Chinese auto industry, rarely making these type of organizational shifts. But starting in March, we're seeing pretty much a new William Li, and it sounds like NIO is trying to really reinvent themselves for success. On March 14th, he emphasized to employees, spend money and time where it counts within effective resource boundaries. On March 23rd, he pushed for greater financial accountability, saying that every account in the company should be clearly calculated. From regional operations to individual vehicles, marketing activities, and R&D projects. This is the kind of financial discipline that NIO has needed. But the question remains, is this course correction coming too late? So anyways, only time will tell. Hope you guys found this episode insightful, useful, helpful, at the very least entertaining. If there's any of those things for y'all, make sure you hit the subscribe button, click the notification bell icon, and leave a comment down below. We'll see you in the next episode of the Courtside Financial Podcast. This is Obi signing off. Goodbye.